Hello everyone, and welcome back to Dr. Tao's Quant Lab. In our last lecture, we covered the four major US indices. We established that the S&P 500 and the Nasdaq are market capitalization weighted. Today, we are going to look at the mathematical consequence of that weighting system. When retail investors buy an S&P 500 ETF, they sleep well at night thinking they are perfectly diversified across 500 independent US companies. I am here to show you that mathematically, this is an illusion. You are not buying 500 equal companies. You are buying a mega cap tech fund with a low volatility anchor attached to it. Let's talk about index concentration and the magnificent nine. You are likely heard financial media talk about the Magnificent Seven, the tech giants that dominate the market. Apple, Microsoft, Nvidia, Amazon, Google, Meta, and Tesla. However, over the last couple of years, the sheer scale of the artificial intelligence infrastructure boom has expanded this elite group. By 2026, modern quantitative traders are tracking the Magnificent Nine, which integrates the world's most critical semiconductor giants, Broadcom and Taiwan Semiconductor, or TSM. Before we move on, I want to give you two crucial index warnings. First, even though Taiwan Semi is one of the most valuable companies in the world, it is a foreign company. Therefore, it is not included in the S&P 500. Second, you might be wondering, what about Berkshire Hathaway, Eli Lilly, and Walmart? They're also worth over $1 trillion. Why aren't they magnificent? It is because the Magnificent Nine is the thematic basket. It tracks the hypergrowth tech and AI narrative. Companies like Berkshire and Walmart are certainly market pillars, but they trade with much lower volatility. They act as the defensive fundamental anchors for the index, rather than its speculative growth engine. To truly understand why institutions obsess over these nine specific stocks, look at the 10-year cumulative growth chart in your lecture notes. Notice that I have to use a logarithmic y-axis. Why? Because the disparity in growth is so vast that a standard chart would mathematically crash the S&P 500 into a flat line at the bottom. Since 2016, the baseline S&P 500 grew by a very respectable 3.4 times. Traditional heavyweights like Apple and Microsoft performed exceptionally well, grows roughly 9 to 10 times. But look at the AI winners. Broadcom grew nearly 25 times, and Nvidia's growth curve completely decoupled from reality, growing an astronomical 235 times over the exact same decade. Because of this disproportionate exponential growth, these 9 companies have effectively consumed the market cap weighted indices from the inside out. Today, the US companies in this elite group account for roughly 35% of the entire S&P 500 and often exceed 45% of the Nasdaq 100. Institutions pour trillions of dollars into these companies to choose certainty. These giants have massive cash reserves, unshakable monopolies, and a remarkably low risk of permanent capital loss. But this creates a massive structural risk for the broad market. Because of this heavy concentration, the S&P 500 can easily choose close green for the day even if 400 out of its 500 companies drop, just as long as, say, Nvidia, Apple, and Microsoft have a strong day. The ultimate takeaway for you as a quantitative trader is this. You cannot trade the macro market indices without simultaneously analyzing the technical structure of the Magnificent Nine. If these tech giants experience a technical breakdown, they possess enough mathematical gravity to drag the entire US economy into a bear market. Now that we understand the heavyweights driving the top of the index, what makes up the rest of it? In our next lecture, we are going to break down the broader market by analyzing the 11 specific GICS sectors. See you in the quant lab.